In March 2023, depositors pulled $42 billion out of one bank in a single day. No lines on the sidewalk, no shouting. The whole run happened on phones. By the next morning, another $100 billion was trying to leave, and regulators seized the bank before noon. What killed it is not a defect in one bad bank. It is built into every bank on Earth, because your money is not sitting in a vault.
Here is what a bank actually is, drawn as a machine. On one side, a tank, deposits. That is money the bank owes you and must hand back the moment you ask. On the other side, bricks, what the bank did with your money. 30-year mortgages, business loans, long-term government bonds. The bricks pay back slowly, over years, sometimes decades, and they cannot be turned back into cash quickly, except by selling them to someone else. Between the tank and the bricks sits a thin layer of actual ready cash. That is the whole design. Borrow short, lend long. It has a name, maturity mismatch, and it is not a scandal. It is what a bank is for.
On a normal day, the machine hums. Some customers take money out, others put money in, and the two flows roughly cancel. The thin cash layer absorbs the difference, and the bank earns its living on the gap. Long loans pay it more than it pays depositors. Your money is there in the only sense that has ever been true, available when a normal number of people ask. The one thing the machine cannot survive is everyone asking at once.
In 1983, two economists, Douglas Diamond and Diamond-Dybvig, wrote down exactly why that is so dangerous. Suppose a rumor starts about your bank. You know it cannot pay everyone. You know it pays whoever asks first until the cash is gone. So if you believe others are about to run, running first is the rational move, even if the bank is perfectly sound. And because every depositor faces the same logic, the fear of a failure can cause the failure. The run is self-fulfilling. That insight won the Nobel Prize in Economics in 2022, and in March 2023, it played out at phone speed.
Silicon Valley Bank was this machine in an extreme configuration. Its tank held about $173 billion, mostly from startups and venture funds, companies that knew each other, shared the same investors, and sat in the same group chats. By the Federal Reserve's count, roughly 94% of those deposits were above the federal insurance cap of $250,000. Uninsured money is nervous money. If the bank fails, it can take losses. And SVB had stacked its bricks almost entirely on one side, long-term bonds, bought when interest rates were near zero.
Then, rates rose faster than they had in a generation. And as this channel drew last episode, when interest rates go up, the price of old bonds goes down. By the end of 2022, the bonds SVB intended to hold to maturity were carrying about $15 billion of paper losses. The bank's entire equity, its cushion against losses, was $15.5 billion. The hole was the size of the cushion. But here is the catch. A paper loss only becomes a real loss if you are forced to sell.
On Wednesday, March 8, 2023, SVB forced itself to sell. It announced it had sold $21 billion of bonds, taken a $1.8 billion loss on the sale, and planned to raise fresh capital to patch the hole. As balance sheet repair, that was survivable. As a signal, it was fatal. Every founder and every fund watching heard the same sentence. The bank needs money.
On Thursday, March 9th, the tank cracked open. Word moved through group chats and board calls, get the money out. And getting money out no longer meant standing on a sidewalk, it meant tapping a screen. In one business day, customers withdrew $42 billion. That is close to a quarter of the bank's deposits, gone between breakfast and close of business. By that evening, SVB's cash balance was negative.
The state regulator later put it at nearly $1 billion below zero.
Friday morning, requests for another $100 billion were already queued and waiting. Added up, roughly 4/5 of the bank's deposits had either left or were trying to leave in about 48 hours. No version of this machine sells bricks fast enough to survive that. Before noon, California regulators took possession of Silicon Valley Bank and handed it to the FDIC. In 1930, killing a bank this size took months of lines around the block. This took 2 days, and nobody stood in line at all.
Runs are not new. This is New York City, 1932. Depositors packed outside the American Union Bank, trying to reach the teller window before the cash ran out. In the early 1930s, roughly 9,000 American banks failed or shut their doors, and the line itself did the killing. The longer it grew, the more rational joining it became. When Congress finally acted in 1933, it did not attack the lines. It attacked the logic. The Federal Deposit Insurance Corporation opened in 1934, guaranteeing at first $2,500 per depositor. Today, the cap is $250,000. Watch what a guarantee does to the queue. Without insurance, your place in line decides whether you get paid, so everyone sprints. With credible insurance, the insured depositor gets paid whether they are first, last, or asleep, so there is no reason to sprint. And if nobody sprints, the run never starts. Insurance does not just repay victims, it deletes the reason to become one. Since 1934, no depositor has lost a penny of FDIC-insured money, a promise backed by a fund of about $157 billion, paid for by fees on the banks themselves, not by taxes.
You can see the switch flip in the data. Bank failures per year, hundreds every year through the 1920s, thousands at the start of the 30s. Then insurance arrives in 1934, and the line collapses and stays collapsed for 90 years. That cluster is the 2008 crisis. That single spike is 2023, Silicon Valley Bank and the banks that fell with it. And all the way at the right edge, this year, 4 small failures, which almost nobody noticed. Hold that thought.
Which leaves the obvious question. If insurance kills runs, why did Silicon Valley Bank die? Because insurance only deletes the queue for the people it covers. And at SVB, more than 9 of every $10 sat above the cap. For that money, 1930s logic still applied, just at 2023 speed. Then regulators invoked what the rulebook calls a systemic risk exception and made every SVB depositor whole, insured or not, with the cost covered by a fee on the banking industry. It worked. The panic faded. It also reopened an old argument. If big depositors get rescued anyway, what keeps them careful about where they bank? Economists still debate whether SVB was truly insolvent or just fatally illiquid. A run rarely strikes at random. It finds a bank with real weaknesses and then finishes it faster than the weaknesses alone ever would have.
Meanwhile, the machine keeps running, and these days, it usually fails quietly. Friday, July 17, 2026, close of business. Kansas regulators seize small business bank of Lenexa, $73 million in assets. The 4th American bank failure of the year. You almost certainly did not hear about it. Over the weekend, the FDIC runs its standing ritual. Take receivership, auction the pieces, sign a deal for a neighboring bank to assume the deposits. Monday morning, the bank's single branch reopens under a new name, Farmers State Bank. And insured customers' money is simply there. Estimated cost to the insurance fund, $5.7 million. No lines, no panic. Boring on purpose. That boredom is what 9,000 dead banks bought.
One question is genuinely open, and Congress is arguing it right now.
Is a $250,000 cap the right size in a world where a run moves at push notification speed? A live proposal, the Main Street Depositor Protection Act, would let the FDIC raise coverage on business checking accounts, the accounts companies use for payroll, to as much as $5 million. Supporters say it would stop operating cash from fleeing smaller banks at the first rumor. Critics say every expansion of the guarantee gives depositors one less reason to care what their bank does with the money. That tension is permanent. Every bank borrows short and lends long. Every bank, always, is running on the belief that not everyone will ask at once. Everything else, the insurance, the Friday seizures, the fights over the cap, is engineering to keep that belief true.